Now, what do we do with these measures of the sensitivity of the bond price to a change in the interest rate? One application is to know what the risk of your portfolio of bonds actually is with respect to a change in the interest rate environment. So if we have a portfolio that simply consists of 30-year zero-coupon bonds, we should know that this portfolio is very risky when it comes to changes in the interest rate. So with moderate fluctuations in the interest rate, we'll have large swings in the value of our portfolio. Now, another application will be the hedging of bonds. So suppose this is the scenario, that we're in a situation where we've got in our portfolio, say, $1 million worth of treasury bonds, and these bonds have 20 years to maturity. They have coupon of 8%. And it turns out the interest rate environment today is 8%, so they are priced exactly at par, exactly at 100, and the value is $1 million. Now suppose that I think that there's a risk that interest rates may increase over the next year. Now, if interest rates increase, we know that the value of this portfolio of bonds will decrease. And we can calculate the modified duration or the elasticity, and if we do that, given the current interest rate environment, we'll find that the modified duration is approximately 9. So that means that if interest rates increase by 1%, the value of the portfolio will drop by 9%. So our $1 million portfolio will lose approximately $90,000. So what are we going to do about this? Well, one thing that we can do is to hedge. Another thing we can do is to actually just get rid of the bonds. So we think that rates are going to go up, why don't we just sell our bonds? Well, it might be that we need to carry some bonds in our portfolio, that we just can't liquidate our bonds and put them into cash or into stocks. So we might want to keep those bonds in our portfolio, but we'd like to protect ourselves against changes in the interest rates. It also might be that we don't want to sell these bonds because we would incur the transactions costs of actually selling them. And these transactions costs are commissions and bid-ask spreads and other things that we'd want to avoid. Another reason perhaps to hedge our bonds. So what are we going to do? Well, the first step in hedging is to assess the risk. In our case, if interest rates go up by 1%, it means that we're going to lose approximately $90,000 on our portfolio. The second thing to do is to assess the sort of position that we need to take to offset this type of risk. The position that we would take would be a so-called short position in the Treasury bond futures market. Okay, now that needs a little explaining given that we haven't talked about futures yet, and we really haven't talked about short positions yet. So, let me try to explain briefly what the futures market does and what a short position actually is in the futures market. And the best way to explain this is not with a bond, but with an agricultural commodity. So, in our situation, the bad scenario is the price going down. This means, as we talked about before, that the interest rates will have gone up. In a higher interest rate environment, the price will go down and the market value of our bonds will decrease. Well, the futures markets began hundreds of years ago, and when there really wasn't an active market in treasury bonds. The markets actually began in a response to agriculture, and farmers actually initiated the need for a futures market. And the farmer's problem is very similar to the problem I described with the treasury bonds. That the farmer is growing a crop, and the farmer is usually levered in terms of borrowing to the bank for farm equipment and other things. And if the price of the commodity that they are actually growing decreases substantially, then they will not necessarily be able to make the payments to the bank and might actually lose the farm. So there is an incentive for the farmer to actually hedge. And the farmer will hedge by using the futures market. And consider the example of corn. And suppose the corn is currently trading for $4 a bushel. And the farmer knows that if the price of corn goes below $3 a bushel, that will cause bankruptcy. So what the farmer can do is to sell in the futures market the crop of corn that the farmer expects for a price, and that price might be $4 a bushel. Now, if the price of corn actually goes down, well, the farmer has agreed to sell at $4. So the farmer's protected. Now, who's going to be on the other side of this transaction? Well, it could be a cereal company. Kellogg's might need the corn for cornflakes. And they're pleased to buy at $4 because they fear that the price might go up to $5. If it goes to $5, then that might affect their competitive position in the cereal market. Kellogg's has got a so-called long position in the corn market, where they've agreed to buy. And they've agreed to buy at $4. The farmer has agreed to sell. And the farmer's agreed to sell at $4. Now, how does this actually work? Well, it turns out that the mechanics of the futures markets are as follows. That if, for the farmer, the so-called bad scenario occurs, the bad scenario being the price dropping, price of corn drops from $4 to $3. What happens is the following. The futures contract is rewritten for the farmer, and the farmer must sell the corn at $3 a bushel. Now, this seems like a bad deal, but it turns out that the farmer is compensated for it. What happens is $1 is transferred into the farmer's account in order to get the farmer to rewrite the contract down to $3 a bushel. That $1 is being transferred from Kellogg's. So Kellogg's pays $1 in order to get the farmer to sell the corn at $3.